but I want to address Gustavo because he asked a question live. We were talking about the delta we'd use for calendar spreads, and Gustavo says how to find the best trades for calendar or vertical credit spreads. We talked about this already a fair amount today. When we talked about the naked puts and the trading plan earlier on, what do I want to look for? Let's say a calendar call or a bull put credit spread. Well, first, for a calendar call or bull put credit spread, I'm going to look for almost the same underlying criteria for the security. I want to see stocks in an uptrend. I want to see stocks that have good positive earnings. I may want to be avoiding, especially with a vertical, the bull put credit or bear call credit. I want to avoid stocks that have earnings between now and expiration. I want to look for criteria that match the sentiment. Calendar call, buying a 6, 10, 12-month out call, selling near-term calls against it. I like to use the term diagonal calendar spread. The horizontal is the same strike. Some people call this the poor man's covered call. I don't like using that term because it's deceiving for investors who are used to covered calls, because the profit on a calendar spread, if you get assigned on the short call, it doesn't continue to this as a covered call does. The capital and the return actually taper off as that call goes more in the money. That's the nature of the spread position. We'll talk about that as well in a moment. But what else do I want to look for? Well, there are investors now who are trading weekly series. Okay, meaning they might be buying an option that's a call option, Gustavo, that's 2 or 3 months out in time and trying to sell week by week against it. Okay, so I would just change my expirations if that's what I was looking for. In general, I'm probably going 6 months out in time, 7 months out in time, if I'm looking for more of a longer term play and to sell near term calls against it. Do I use calendar spreads? Yes, I do. What I use calendar spreads more on is higher price stocks that I can't afford to do as a married put or a collar position in my account. You know, I'm looking at $400, $500, $800 stocks instead of buying them 100 shares and trading it as a married put, following the rules in the blueprint, or a covered call or a collar. I'm buying on the $500 stock, I'm buying maybe a 470 or 480 call that's 6 months out in time and still selling the near term against it. So I'm paying 1/5 to 1/6 the price of the underlying security. You have to decide your time frame. Okay, I prefer to use it maybe 6 months out of time. I'm going to go 180 out in time to maybe, let's just say 1 year. 1 year is 450 now. We'll just keep it there. But yeah, let's keep it shorter term. I'm going to look 10 to 20 days out in time, 10 to 30 days out in time. We're not near October expiration yet, so this is going to pull up weeklies only for me. Or I could just choose to look at standard October expiration. If you wanted to try week by week, Gustavo, you would just look maybe 0 to 10 days out in time here, and you're buying 60 to 90 days out. What doesn't change? The delta. I want to look for a delta on my long of at least 0.6. I want to be in the money with this call that I'm buying for the strategy. I might even go higher to 0.7 in this case. But what I also want to look for is a good delta ratio. What is this? It's the delta of the long divided by the delta of the short. And I probably want to start off at least 1.8, 1.7 in that case. And I'm going to look for some other basics. You know, I want a minimum option bid of 15 cents. I want to be about 5% in the money with the long call. But on this calendar, you know, I'm shading the expiration based on what I need, but long option delta of 0.7, delta ratio of 1.7, and debit to strike difference ratio of less than 1. What is this? What is this field, Gustavo? Let's take a look. I'm going to change these parameters and run the search real quick. Good. Oh, it's all micron. I want a good, reasonable return. And what else did I mention? Some good stock criteria. Earnings per share growth greater than 5, avoiding earnings between now and the short call expiration, relative good PE ratio, good broker rec, and I'm going to look for a stock that's trading in an uptrend. Okay? What is that debit to strike difference ratio I was looking for? Do I have a 75, 65? No, that's fine. I'm going to use a 75, 62.5. All right, so what is this micron position? I'm buying a March 6 month out 62.5 call for 14.28 and selling an at the money 75 call for 2.35. I'm paying a debit on this position of 11.93 per contract. And Why is that important? Well, I've got a 12.5 point spread. I bought a 62.5, I'm selling a 75. Why is that important? Well, it's important. This is one of the main ones here. It's really important to do this because if the stock suddenly shoots up above 75 and I'm assigned early on this call, my broker will hopefully exercise the 62.5 and I'd get $12.50 back. That's not a $320, $318 return or $3.18 return. It's only about 60 to 70 cents. That's right. This return at expiration, we sold the October 8th 3-week out call. The return here is based on what is the remaining long call value, including time premium that exists in that long call based on the Black-Scholes pricing model. If the stock was trading at the perfect price, the short call strike price of 75 on the 8th of October. That's where this comes from. But if I allow, and that's based on being able to sell to close the call, and that's what I'd want to do on the first run. If I hit my target, I'd want to sell to close. I have the right to sell to close the 62.5 call and get the time premium that still remains, buy to close that for whatever price. If I allow assignment, though, I'm missing out on all the time value. I'm only getting the $12.50 back, not this time value that would still remain in the 62.5 if the stock was at 75. It might still be $2 or $3. That's gone if I allow assignment. And why do I not like to use the term poor man's covered call? Well, we talked about delta for the long being at around 0.7 and looking for that good delta ratio and the importance briefly, but very important, of the debit to strike difference ratio being less than 1. Most investors who come from a covered call and say, I want to use leverage and do this, what they don't see is that maximum return only exists if the stock's trading right at the short call strike price at expiration. Why does it taper off as it keeps going up? This March option we know is starting off with a delta of 0.7 or higher. And as the stock moves up, the delta is going to go to 0.75 and 0.8. As we get close to the 8th of October expiration, let's say the stock moves up to 80. Well, my 60 call is deeper in the money, but it's a March call. It's still only maybe at a delta of 0.85 or 0.9. Where's my 80 delta going on October 7th? I'm sorry, where's my 75 delta going if the stock's at 80 and I'm 1 day to expiration? This is at 1. It's at 0.99 or 0.1. What happens as you get near to the short call expiration is the deltas flip. Yes, you're gaining delta on the 62.50 call that you bought, but it's not going to 1. If the stock's above 75, even if it's at 75.50, this short call, 1 day left to expiration, 2 hours left to expiration, is going to a delta of 1. So now every point the stock moves up, you're losing closer to $1 here, and you're only gaining 85 cents here. That delta ratio we wanted switches at expiration. And that's why the max profit tapers off as it goes deeper in the money. But the debit to strike difference ratio is important, meaning that the debit I pay is always less than the difference in strikes, and that's a filter to use, because if I paid $16 for this and only got $2.35 back, my net debit's $13.65. My difference in strike prices is $12.50. What happens? If the stock really gaps up in price, I actually lose. Unlike an investor who might be used to a covered call, where that profit stays the same and you're always at a profit if it's anywhere above your short call strike price, the max return of 2 or 3%. This doesn't happen in a calendar spread. If you paid too high of a debit, if your debit was greater than the difference in strikes, the stock can actually go up as you expected and you can lose money on the position if you're assigned. Because I'm only getting $12.50 back, but I paid a debit in this example of $13.65, so I'm actually at a loss of $1.15. Okay? But that's what you're looking for. You're looking for good stock criteria that match what you'd look for a bullish stock in an uptrend, good earnings per share growth perhaps to reflect, and maybe a good PE, avoid earnings between now and expiration, maybe looking for stocks above the 20-day moving average, Gustavo, or the 50-day, or maybe using a positive MACD. Set your expiration time frame to what you want. You want a minimum return of 4 or 5% on the first cycle. You want to be slightly in the money on the call, 3, 4, 5%. Look for a long option delta of greater than 0.6 or 0.7. delta ratio of maybe greater than 1.8, and keep that debit to strike difference ratio less than 1. If I was doing a bull put credit spread, we talked about this already. Same things we'd look for the iron condor, Gustavo. But in a vertical spread, bull put credit, for example, I'm going to be looking for what? Minimum return of 9% to have the leverage in my favor, 3 to 4% out of the money, 10 to 14 days out to maximize the highest annualized return, just as I am so sorry. Was that live question that came in? James, I'm sorry, James. Just like he was looking for in the short strangles, just like we talked about in the iron condors, which in a sense are vertical spreads. We're looking for an 85% probability or higher. And I might want to look for strike differences that match my goals. I like to look for strike differences greater than 2, not using the 50-cent strike differences for that as well. Simple moving average, stocks above the 20-day moving average, avoiding earnings between now and expiration, positive MACD crossover. I know I'm going over this fast, Gustavo, but the reason why is if you go to our free webinars page, you go into option strategies, scroll down here to some older presentations. It's actually a public site, powerop.com/webinars.asp. I'm going to go back here to about 2018. Here you go, 2019. Good candidates for poor man's covered call. A full 30-minute presentation on looking at the diagonal spread. What is it? What criteria to use? Profit and loss outcomes. Further down here, there's some more. I'm looking, going back to 2018. How to be successful with spread trades, calendar spread criteria, and calendar spread basics. This is a full presentation here, but I think the best ones you want to watch are maybe how to be successful with spread trades and credit spreads, the basics, bull put, bear call, talking about your vertical spreads, going into the criteria, credit spreads beyond the basics, part 1, to look at expectations, structure, criteria, position sizing, and more. And in addition to that, so we saw that one there, the poor man's covered calls from 2019. Good candidates, 12/10/2019. Good candidates for poor man's covered call. You could also go to our YouTube channel, and you could search specifically in the video. Go to our YouTube channel, go to videos, and you could search for poor man's covered call or bull put credit spread. You'll see a lot of videos there that go through that, Gustavo. So I know we're short on time, and I went through that very quickly on the calendar spread criteria. But either on the webinars page, or if you search for poor man's here, you just have to search for poor man's, let's say. Good candidates for poor man's covered call. Comes right up, 32 minutes on the discussion of what we talked about on the profits and loss chart. And here's follow-up to best criteria for poor man's covered call. And of course, you scroll further down, you'll see the discussion on the best criteria for the poor man's covered call, or on the webinars page there. Do the same thing. You could do diagonal spread or poor man's covered call. But you also just search for bull put. Triggers management, that's criteria, when to exit. A lot of techniques on management. Bull puts credit spread criteria. What are we talking about? 31 minutes. Defaults, adjustments, and a sneak peek there to an upcoming product we have. And you could also search for bear calls, Gustavo, right there and see them all as well.